They are scrambling. The United States government spending $7.4 billion, not on infrastructure, not on healthcare, not on education, on silver. December 15th, 2024, a deal was signed behind closed doors. The Pentagon took a 40% stake in something they haven't built on American soil in 50 years. While the world watched stock markets and cryptocurrencies, the most powerful military on earth quietly moved to secure a metal that cannot be printed, cannot be created, and is running out faster than anyone publicly admits. What do they know that the markets are ignoring? Welcome to Currency Analyzer. Now, before we dive into what might be the most significant resource move of this decade, let me ask you something. You've been around long enough to know that when governments move this fast, this quietly, with this much money, something serious is happening. So do me a favor, hit that subscribe button right now. Not because I'm asking, but because what you're about to hear needs to reach people who still remember when America built things, when we controlled our own supply chains, and who understand that $7 billion doesn't get spent unless there's $7 trillion worth of consequences. Also, drop a comment below. Tell me, where are you watching this from? Are you in the States, watching your government scramble, or are you overseas, watching the world's reserve currency nation panic over a metal? Let's begin. On December 15th, 2024, while American families prepared for Christmas, while traders focused on year-end bonuses, while the financial media debated Bitcoin's next move, the United States Department of Defense signed a document that changed everything. $7.4 billion, a partnership with Korea Zinc, a massive metal processing facility in Clarksville, Tennessee, the first major non-ferrous metal smelter to be built on American soil since the 1970s. 50 years, for half a century, the United States was comfortable, letting other nations do the dirty work of processing metals. They sent raw materials to China, to South Korea, to Japan, and they imported the finished product. Clean hands, cheap prices, efficient supply chains, or so they thought. But something changed in December, something that made the Pentagon, the most powerful military organization in human history, take an action they haven't taken in 5 decades. They didn't just fund this project. They became owners, a 40% equity stake. Let that sink in for a moment. The United States military now owns nearly half of a metal processing facility. They are not customers waiting in line to buy metals on the open market. They are not signing contracts, hoping suppliers will deliver. They are the owners of the production capacity itself. This is not how free markets work. This is how governments behave when they are afraid, when they look at their stockpiles and see them running dangerously low, when they look at their supply chains and realize they are vulnerable, when they understand that the metals they need for national defense are controlled by nations that may not always be allies. The facility will process 1.1 million tons of raw material every single year. It will produce 13 different metals. 11 of those 13 are classified by the United States Geological Survey as critical minerals. Critical means essential for national security. Critical means without them, the military cannot function. Critical means they cannot be substituted with anything else. And at the top of that list sits silver, not gold, not platinum, silver. The metal that conducts electricity better than any other element on Earth. The metal that reflects light and heat with unmatched efficiency. The metal that is irreplaceable in missile guidance systems, in fighter jet electronics, in satellite communications, in radar technology. The metal that every modern weapon system depends on. And here is what most people do not understand. The silver that comes out of this facility will not go to the open market. It will not be sold to electronics manufacturers in Asia. It will not be available to solar panel companies. It will not help jewelry makers or industrial users or anyone else. It goes straight into United States military stockpiles. It is being removed from the commercial supply before it is even refined. The government looked at the global situation in December, and they saw something that terrified them. China, the world's largest processor of critical minerals, preparing export restrictions. Mexico, the world's largest silver producer, seeing output decline year after year. The world's largest silver producer, seeing output decline year after year. Peru, the second largest producer, facing political instability and mining disruptions. And across every major economy, industrial demand for silver exploding. Solar energy installations, consuming over 100 million ounces annually. Electric vehicles, requiring more silver per unit than traditional cars. 5G infrastructure, rolling out across the globe, demanding unprecedented quantities. The math was simple and terrifying. Global mining production, approximately 800 million ounces per year. Global industrial demand, approaching 1 billion ounces per year. The deficit, growing wider every single year. Investment demand, not even calculated in those numbers yet. For years, analysts had warned about this. For years, silver advocates had pointed to the supply deficit. For years, they were dismissed, laughed at, called conspiracy theorists. But in December, the Pentagon looked at the same data, and they did not laugh, they acted. $7.4 billion is not a research grant. It is not a pilot program. It is not a gesture toward energy independence. It is an emergency response to a crisis that most people do not even know exists yet. Because when the United States military takes a 40% ownership stake in metal production infrastructure, they are not planning for prosperity. They are preparing for scarcity. The question is not whether a supply crisis is coming. The question is, how did they know to move in December, right before everything started to break? January 1st, 2025, 16 days after the Pentagon signed the Tennessee deal, China made an announcement. It was buried in a government ministry statement, written in careful diplomatic language, released on a holiday when Western markets were closed. But the message was unmistakable. Strategic mineral exports restricted, not banned, restricted. A word that sounds softer, but means something far more dangerous. It means China decides who gets what. It means licenses required. It means delays, paperwork, bureaucratic obstacles that can appear or disappear based on political relationships, antimony, critical for military ammunition and infrared technology, restricted. Gallium, essential for semiconductors and satellite systems, restricted. Germanium, required for fiber optics and night vision equipment, restricted. And while silver was not explicitly named on that list, anyone who understands metal processing knew exactly what it meant. Because China does not just mine these metals. China refines them. China processes them. China controls 70% of the world's refining capacity for critical minerals. Of the world's refining capacity for critical minerals. A mine in Peru can pull silver from the ground, but without Chinese processing infrastructure, that silver remains unusable ore. This is the leverage that decades of offshoring handed to Beijing, and in January, they reminded the world that they hold it. But China's move was only one crack in a supply chain that was already fracturing. Mexico, historically the world's most reliable silver producer, saw output drop 4% in 2023, another 3% in 2024. Mines aging, grades declining, new discoveries not keeping pace. The silver that built Mexico's mining reputation for centuries, getting harder to find, more expensive to extract, less profitable to produce. In Peru, protests shut down major mining operations for weeks at a time. Political instability, indigenous land rights disputes, environmental conflicts, all colliding in the world's second largest silver producing nation. Production forecasts constantly revised downward. Delivery schedules perpetually delayed. And the global industrial machine kept demanding more. Solar panel manufacturers needed silver for photovoltaic cells. Every panel requiring 20 grams of silver, irreplaceable, because nothing else conducts electricity with the same efficiency at the same cost. Global solar installations projected to triple by 2030. That is not a forecast. That is policy. In the United States, in Europe, in China, in India, governments mandating renewable energy without asking where the silver will come from. Electric vehicle makers discovered that their sensor arrays, their battery management systems, their charging infrastructure, all require silver. More silver per vehicle than traditional cars. And global EV production targets climbing every quarter. 5G networks rolling out across every major economy. Each cell tower, each connection point, each relay station, silver conductors, silver switches, silver contacts, millions of connection points, billions of signals, all flowing through a metal that annual mine production cannot keep up with. Defense contractors building hypersonic missiles that require silver and guidance systems. Satellite constellations launching hundreds of units per year, each loaded with silver components, radar installations, communication networks, electronic warfare systems, all dependent on the same metal that solar companies and tech manufacturers are competing for. The Tennessee facility, designed to process 1.1 million tons annually, will produce multiple metals simultaneously. But even at full capacity, projected for 2027 at earliest, it represents less than 5% of current global refining capacity. A drop in an ocean of demand. But here's what makes the Pentagon's move so revealing. They are not building this facility to supply the market. They are building it to supply themselves. 40% ownership means 40% of output goes to military stockpiles before commercial buyers get a chance to bid, before industrial users can place orders, before the market even sees it. This is not capitalism. This is not free market resource allocation. This is resource nationalism. The same strategy China employed with rare earth elements in 2010. The same approach Russia used with titanium and enriched uranium. The same playbook that emerging economies have studied for decades. Control the processing, control the supply, control the leverage. And now, the United States is playing the same game. Because they looked at the global supply chain in December. They saw China preparing restrictions. They saw production declining in Mexico and Peru. They saw industrial demand accelerating beyond mining capacity. They saw commercial markets unable to deliver the volumes military operations require. And they made a decision. If the free market cannot guarantee supply, then the government will secure it by force of capital. $7.4 billion buys more than a facility. It buys priority access. It buys guaranteed delivery. It buys independence from suppliers who might become adversaries, but it also confirms what market analysts have been whispering for years. The physical supply is breaking. And governments know it before markets price it in. The scramble has begun. There's a name buried in the financial documents of the Tennessee Project, a name that should not be there, a name that creates a contradiction so profound that it reveals the entire game. A contradiction so profound that it reveals the entire game. J.P. Morgan Chase, lead financing institution, structuring the debt, arranging the capital, facilitating the deal. The same J.P. Morgan that for 15 years has been documented, investigated, fined, and convicted for manipulating the silver market. Let that paradox settle for a moment. The bank that spent over a decade suppressing silver prices through paper contracts is now financing the largest physical silver infrastructure project in half a century. The bank that the CFTC fined $920 million in 2020 for spoofing, for fraud, for manipulating precious metals markets is now the financial architect behind a government facility designed to secure physical metal. This is not a coincidence. This is not irony. This is a strategic pivot, and it tells us everything about what the smart money sees coming. JP Morgan is not stupid. They are not gamblers betting on trends. They are the house, and the house does not finance projects that threaten their position, unless their position is about to collapse anyway. For years, silver investors watched JP Morgan accumulate massive short positions on the COMEX futures exchange, paper contracts promising to deliver silver they did not own, leverage ratios reaching hundreds to one, physical silver in vaults versus paper claims on that silver, completely disconnected. As long as most traders settled in cash instead of demanding delivery, the system worked. Prices stayed suppressed. Despite industrial shortages, physical premiums climbed while paper prices remained flat. A two-tier market hiding in plain sight. But something changed in the last 2 years. Delivery requests started increasing. COMEX inventories started declining. Registered silver available for delivery dropping to levels not seen in decades. And then Shanghai started trading at a premium, not a small premium, not a temporary dislocation. On January 5th, 2025, Shanghai silver traded at $82 per ounce. COMEX silver, $31. The same metal, the same day, separated by an ocean, and $51. That is not a price difference. That is a market breaking in two, physical versus paper, reality versus contracts, and JP Morgan saw it coming. So they did what sophisticated players always do when they see the game changing. They hedged, not by closing their short positions that would crash the paper market immediately, not by admitting the manipulation that would invite legal catastrophe, but by quietly, methodically, positioning themselves on both sides, maintain the paper shorts, collect the premiums, control the COMEX pricing, while simultaneously financing physical infrastructure that will produce real metal outside the paper system. When the paper market finally breaks, and it will break because mathematics always wins eventually, JP Morgan will have exposure to physical production capacity, They will have relationships with the Pentagon, with Korea Zinc, with the supply chain. They will transition from paper market makers to physical infrastructure financiers. Survival, disguised as patriotism. But here's where it gets even more interesting. Korea Zinc, the operational partner in this deal, is not just any smelting company. They are the world's largest zinc refiner and one of the top 3 silver refiners globally. They process ore from dozens of countries. They have relationships with every major mining operation in the Asia-Pacific region. They understand metal markets at a level that American companies forgot decades ago. And they are bringing that expertise to Tennessee. The Pentagon gets 40% equity in operational control over output allocation. Korea Zinc gets access to American ore sources, long-term contracts, and a physical presence inside the United States market. JP Morgan gets financing fees, relationship capital, and a hedge against the paper system they created. Everyone wins, except the commercial market, because the deal structure explicitly states military requirements take priority. Strategic stockpiles get first allocation. Commercial buyers get what is left, if anything, is left. This is the quiet nationalization of supply chains, not through seizure, not through legislation, not through drama, through equity stakes, through financing structures, through partnership agreements that look like business deals, but function like government control. The Department of Commerce provides regulatory support. The Department of Defense provides capital and demand guarantees. The Infrastructure Investment and Jobs Act provides loan guarantees. The Defense Production Act provides legal authority to prioritize defense contracts over commercial orders, layer by layer. The appearance of free markets with the reality of state direction. And the timeline reveals the urgency. Construction begins late 2025. Phase 1 operations projected for 2027, full capacity. 2028 at earliest. 3 years minimum before a single ounce comes out of Tennessee. 3 years where the supply deficit continues widening. 3 years where China controls refining. 3 years where commercial users compete for shrinking supply. 3 years where the gap between paper prices and physical reality grows impossible to ignore. JP Morgan knows this. The Pentagon knows this. Korea Zinc knows this. They are not building this facility to solve today's problem. They are building it to survive tomorrow's crisis. Because when the paper market finally admits that it cannot deliver the physical metal it has promised, when the COMEX registered inventory hits zero, when Shanghai and London and New York are trading the same metal at completely different prices, when industrial users start hoarding instead of just-in-time ordering, the entities with access to physical production will control everything. And JP Morgan, the architect of paper suppression, will have quietly repositioned itself as a gatekeeper of physical supply. That is not coincidence. That is the smartest money in the world, reading the room and heading for the exits while the door is still open. The Tennessee facility is not an isolated event. It is a template, a blueprint that other nations are already studying. Because what the United States did in December confirms a shift that has been building across the entire global economy. Resource nationalism is no longer a theory, it is policy. China started this playbook in 2010 with rare earth elements. They controlled 90% of global production. They controlled 100% of processing capacity, and then they restricted exports. Prices exploded overnight. Defense contractors panicked. Technology companies scrambled for alternatives. The entire Western industrial complex realized they had outsourced their own vulnerability. It took a decade for the United States and allies to rebuild even partial rare earth processing capacity. A decade of shortages, of price volatility, of strategic weakness. The lesson was clear: control processing, control leverage. Russia applied the same principle to titanium and enriched uranium. Indonesia to nickel refining. The Democratic Republic of Congo to cobalt. Each nation realizing that raw materials are leverage, but processed materials are power. And now, the United States is joining that game. Not because they want to, because they have to. The defense industrial base is more vulnerable than most Americans realize. Every F-35 fighter jet requires approximately 1,000 ounces of silver, guidance systems, radar arrays, electronic warfare suites, communication networks, all dependent on a metal that the military does not control the supply of. Tomahawk cruise missiles use silver in targeting computers and sensor arrays, satellite constellations, both military and commercial, require silver in solar panels, circuit boards, and reflective coatings. The Pentagon has never publicly disclosed exact silver requirements for weapon systems, but industry analysts estimate that current military procurement consumes between 10 and 15 million ounces annually. That is the known demand. The classified demand for experimental systems, hypersonic weapons, directed energy platforms likely doubles that number, and that demand competes with commercial markets that are already in deficit. So the Pentagon made a decision. If we cannot rely on markets to deliver what we need, then we build our own supply. We own the production capacity. We control the output. We guarantee that national security needs are met first. This creates a cascade effect that most analysts are not yet pricing in. If 40% of Tennessee facility output goes to military stockpiles, that is 40% that commercial markets will never see. Solar manufacturers competing for a smaller pool, electronics companies bidding on reduced supply, EV makers facing allocation decisions they are not prepared for, and the facility, even at full capacity, represents less than 5% out of global refining. It helps the Pentagon. It does nothing for the commercial deficit, which means the price discovery mechanism that has governed silver for decades is about to face a reckoning, because markets operate on the assumption that supply and demand find equilibrium through price. If demand exceeds supply, prices rise until demand decreases or new supply emerges. But what happens when a major buyer removes themselves from the price discovery process, when the Pentagon pays whatever it costs because national security has no price ceiling, when they secure supply through equity ownership instead of market purchases, the commercial market gets smaller, more buyers chasing less metal, and the paper contracts that have suppressed prices for years become increasingly disconnected from physical reality. Shanghai trading at $82, while COMEX sits at 31, is not an anomaly. It is a preview. Two markets, two prices for the same metal. One based on paper promises, one based on physical delivery. History shows us how this ends. In every commodity, where paper leverage exceeded physical supply, the paper market eventually collapsed into the physical price, not the other way around. Reality does not adjust to contracts. Contracts break against reality. The business community needs to understand what this means in practical terms. If you operate a company that depends on silver for manufacturing, your procurement strategy, built on just-in-time delivery and spot market pricing, is obsolete. The new reality requires long-term contracts with physical delivery guarantees. It requires higher inventory levels, despite the capital costs. It requires supply chain diversification across multiple refiners in multiple countries. It requires understanding that price is no longer the primary variable. Availability is, because when governments start securing supply through ownership, commercial buyers become secondary. They get what is left over, and what is left over may not be enough. This is not fear-mongering, this is pattern recognition. The Pentagon does not spend $7.4 billion on metal processing infrastructure unless they have run scenarios that terrify them, unless they see a future where commercial markets cannot deliver what national defense requires, unless they understand that the free market only works when there's enough supply for everyone. And there is not enough supply for everyone. The math is undeniable. 800 million ounces mined annually, 1 billion ounces consumed annually, 200 million ounce deficit every single year, filled by above ground stockpiles that are not infinite, filled by recycling that cannot scale fast enough, filled by reduced consumption that conflicts with government mandates for green energy. Something has to give. Either industrial demand gets rationed, or prices rise until demand destruction occurs naturally, or governments start deciding who gets supply and who does not. The Tennessee facility suggests they have already made that choice, military first. Strategic industries second. Everyone else competes for the remainder. This is the new architecture of critical mineral supply chains, not built on markets, built on strategic priorities. The scramble that began in December is not going to slow down. It is going to accelerate. more facilities, more partnerships, more government equity stakes in silver, in lithium, in cobalt, in rare earths, every critical mineral that current supply chains cannot reliably deliver. And every business that depends on those materials needs to understand the rules have changed. The government is no longer just a customer. They're now a competitor with deeper pockets, longer time horizons, and the legal authority to override commercial contracts when national security is invoked. $7.4 billion is not the end of this story. It is the beginning of a world where access to materials matters more than access to capital, where what you can secure physically matters more than what you can buy on paper. The United States government looked at their silver supply in December, and they scrambled. The question for every business leader watching this is simple. When will you? If this analysis changed how you see supply chains, if it made you rethink your procurement strategy, if it revealed risks you had not considered, then share this with someone who needs to hear it. Subscribe to Currency Analyzer for strategic economic analysis that cuts through the noise. And leave a comment below. Tell us, is your industry vulnerable to resource nationalism? Have you already seen signs of this scramble in your supply chains? The conversation starts now.